has been charged by the U.S. Department of Justice for his alleged involvement in a multi-million-dollar fraud scheme.
Here is how a nearly $1 billion fraud works. You do not steal it all at once. You do not walk into a bank with a gun. You build something real first, something credible, something that attracts sophisticated investors who have done their due diligence and believe, genuinely believe, that they are buying into a legitimate, growing technology business. Then you manipulate the numbers, quietly, systematically, over years, until the gap between what the business actually is and what the paperwork says it is becomes so large that the only way to keep it hidden is to raise more money, close more deals, and push the fiction further forward, until it collapses. In April 2025, the United States Department of Justice unsealed charges against the former CEO and CFO of Mobileum.
Facebook, Google, and Amazon and many other companies are sending a message today to users and government regulator.
A Silicon Valley telecommunications software company alleging a fraud scheme spanning multiple years involving fabricated revenue, falsified financial statements, and the deliberate deception of private equity investors who committed hundreds of millions of dollars based on numbers that prosecutors allege were constructed rather than earned. The alleged fraud totals nearly $1 billion. And the reason this case matters, beyond the scale, beyond the charges, beyond the personal destruction that always accompanies a collapse of this kind, is what it reveals about the specific vulnerabilities of the private equity investment model, about the due diligence gaps that sophisticated institutional investors consistently fail to close, and about how a determined management team inside the right corporate structure can allegedly sustain a financial fiction for long enough to cause damage at a scale that was once thought to require the complexity of a public company. This is that story. Chapter 1. What Mobileum was. To understand the fraud, you first have to understand the business, because the most effective financial deceptions are always built on something real. And Mobileum was, at its core, a legitimate technology company operating in a genuinely important market. Mobileum provides software and analytics services to telecommunications carriers, the companies that run the global networks that mobile phones depend on. Its products cover roaming management, network analytics, security, and testing services. These are not glamorous product categories, but they are essential infrastructure for the global telecoms industry, and the companies that provide this software well can build durable, high-margin businesses with sticky customer relationships. Mobileum was formed through a series of acquisitions, consolidating several smaller telecom software businesses into a single platform company. By the time private equity investors became seriously involved, the company had genuine customers, genuine contracts, and genuine revenue. It was operating in a real market with real competitive dynamics. This is the critical context for everything that follows. The alleged fraud at Mobileum was not the construction of a company from nothing, the kind of pure fiction that characterized, for instance,
the jury is set for the case against former Theranos CEO Elizabeth Holmes. She is charged with defrauding people.
The Theranos case, or the Wirecard collapse. It was, according to the Department of Justice charges, the systematic inflation of a real business, the manipulation of real revenue figures upward, the fabrication of contracts and customer relationships that did not exist, layered on top of ones that did. That combination, real foundation, allegedly falsified superstructure, is what made it so difficult to detect. And it is what made the private equity investors who backed the company so confident that their due diligence had been adequate. It had not been. But understanding why requires understanding how the alleged manipulation was structured. Chapter 2. The alleged mechanics of the fraud. According to the Department of Justice indictment, the fraud at Mobileum operated through several interconnected mechanisms, each one designed to inflate the financial metrics that private equity investors use to value software businesses. The primary metric in question was ARR, annual recurring revenue. In the software industry, ARR is the single most important number. It is the foundation of company valuation. It drives the revenue multiples that determine what a private equity buyer pays when they acquire a software business, and what they receive when they sell it. A software company trading at 10 times ARR with $100 million in ARR is worth $1 billion. Inflate that ARR to 150 million, and the same multiple produces a valuation of 1.5 billion. The manipulation of a single number changes the transaction by $500 million. According to prosecutors, Mobileum's former CEO, Bobby Srinivasan, and former CFO, Robert Maddock, allegedly orchestrated the inflation of ARR figures through multiple methods. These included recording revenue from contracts that had not been executed, recognizing revenue from customers who had not agreed to the terms being reported, and in some cases, fabricating customer relationships entirely to support revenue figures that could not be justified by actual signed agreements. Beyond ARR manipulation, prosecutors allege the scheme involved falsified financial statements presented to lenders and investors, the creation of documentation designed to support fabricated revenue figures during due diligence processes, and the active concealment of the gap between reported and actual financial performance from the company's outside auditors. The scale of the alleged fabrication is significant. Prosecutors allege that the gap between what was reported and what was real grew over time, as is typical in fraud schemes of this structure, because each reporting period required new fabrications to maintain consistency with the false figures previously provided. One of the most important details in the indictment is the allegation that the fraud was not a spontaneous decision made in response to financial pressure. It was, according to prosecutors, a deliberate and sustained scheme executed over multiple years with the specific intent to deceive investors and lenders in connection with financing transactions worth hundreds of millions of dollars. That intent element is critical. It is the difference between aggressive accounting, which is common in private equity-backed companies under pressure to hit metrics, and criminal fraud. And it is what the prosecution will need to establish convincingly at trial. Chapter 3. The private equity context. Here is where the Mobileum case becomes a story about an industry, not just a company. Private equity investment in software businesses has been one of the most active and competitive segments of the global financial market for the past decade. According to PitchBook's 2024 private equity market data, software and technology businesses accounted for over 30% of total private equity deal volume by value globally in 2023. The sector attracted this capital because software businesses, particularly those with subscription revenue models, generate the kind of predictable, recurring cash flows that private equity firms can lever, optimize, and exit profitably within their typical 3 to 7 year investment horizon. The competition for high-quality software assets drove valuations to levels that created significant pressure on every participant in the transaction ecosystem. Sellers needed to show ARR growth to justify premium valuations. Management teams at portfolio companies were compensated on metrics, primarily revenue growth and EBITDA, that created direct financial incentives to produce strong numbers. And private equity buyers, under pressure to deploy capital in a competitive market, were conducting due diligence processes that were, in some cases, compressed in timeline and scope relative to the complexity of the businesses being acquired. This pressure environment does not excuse fraud, but it explains the conditions in which fraud of this type becomes both tempting and, for a period, survivable. According to research published by the Association of Certified Fraud Examiners in its 2024 report to the nations on occupational fraud and abuse, financial statement fraud, the category most directly applicable to the Mobileum allegations, represents the highest dollar impact category of corporate fraud, with a median loss per case of $800,000. But cases involving senior executives at private equity-backed companies in high-growth sectors consistently produce losses far above that median. Because the valuation multiples applied to manipulated metrics amplify the financial impact of each dollar of fabricated revenue. In a business valued at 10 times ARR, $1 of fabricated recurring revenue creates $10 of fictional enterprise value. The leverage the multiple provides to legitimate growth also provides leverage to fraud. And in the private equity software sector of the past decade, where ARR multiples frequently reached 15, 20, or even 25 times in competitive deal processes, the financial amplification of revenue manipulation was extraordinary. Chapter 4: How it unraveled. Financial frauds of this structure do not typically unravel through a single dramatic discovery. They unravel through accumulation, a series of small anomalies that individually appear explainable, but collectively become impossible to ignore. In the Mobileum case, the unravelling appears to have been accelerated by the involvement of multiple financing parties, lenders as well as equity investors, who were independently reviewing financial data and at some point began to encounter inconsistencies that the company could not reconcile. According to the Department of Justice charges, the scheme was discovered in connection with financing transactions in which the company provided materially false financial information to lenders. When lenders began conducting independent verification of the financial data provided, a standard element of credit agreement compliance monitoring, the gap between the reported figures and the verifiable reality became apparent. What typically follows in cases of this structure is significant. Once a lender identifies a potential material misrepresentation in a borrower's financial statements, the legal and regulatory machinery moves quickly. Credit agreements typically contain representations and warranties about the accuracy of financial information provided. And a material breach of those representations triggers default provisions, acceleration of debt, and, in cases where the misrepresentation appears intentional, referrals to law enforcement. The Department of Justice investigation that produced the 2025 indictment reflects exactly this sequence. The financial anomalies identified by lenders led to an investigation that ultimately produced criminal charges against the two most senior executives of the company. Both Bobby Srinivasan and Robert Maddock were charged with wire fraud and conspiracy. The charges carry potential prison sentences that, if convictions are obtained on all counts, could result in decades of incarceration. The company itself, Mobileum, is separate from the individuals charged. The business continues to operate under new leadership, working through the financial and reputational consequences of the alleged fraud conducted by its former executives. Chapter 5: What the investors missed and why. This is the part of the Mobileum story that the private equity industry will find most uncomfortable. Because the investors who committed hundreds of millions of dollars to this company were not unsophisticated. They had experienced deal teams. They had access to outside auditors, financial advisors, and legal counsel. They conducted due diligence processes that, by the standards of the industry, were thorough. And they allegedly missed a fraud that in retrospect was hiding in the numbers the entire time. According to research from the Harvard Business School on private equity due diligence practices, the most significant gap in standard PE due diligence is customer verification. Financial statement analysis, management interviews, and auditor review are all standard. Independent direct verification of reported customer contracts and revenue relationships, talking directly to the customers whose contracts are being used to justify the valuation, is conducted far less consistently than the other elements. This gap is particularly significant in software businesses, where revenue is recognized under complex subscription and usage-based arrangements that can be structured in ways that make verification difficult without deep operational access. A customer that has signed a contract may not be generating the revenue attributed to them if the contract terms include contingencies, performance milestones, or renewal conditions that affect when and whether revenue is actually earned. The Mobileum case, if the prosecution's allegations are sustained, represents a direct exploitation of this due diligence gap. The alleged fabricated revenue was structured to appear consistent with the company's real customer base and real contract patterns, making it difficult to identify without the kind of granular, bottom-up customer verification that deal timelines and competitive dynamics frequently make impractical. The lesson for institutional investors is not new. It has been articulated after every major private equity fraud case. Verify revenue at the customer level, not through management-provided documentation, directly, independently, with the actual customers. The lesson is known, it is not consistently applied, and until it is, cases like Mobileum will keep happening. Closing chapter, the broader reckoning. The Mobileum case is one data point in a larger pattern that the private equity industry has been slow to fully reckon with. According to the Association of Certified Fraud Examiners 2024 data, private equity-backed companies are overrepresented in financial statement fraud cases relative to their share of total corporate activity. The structural dynamics that make PE-backed businesses attractive, high growth targets, management equity incentives, compressed reporting timelines, and valuation multiples that amplify the financial reward for hitting numbers, also make them environments where the temptation and the practical opportunity for financial manipulation are elevated. This does not mean private equity is a fraud-ridden industry. The overwhelming majority of PE-backed companies are managed with integrity, but the structure of the model creates specific pressure points that, in the absence of robust verification practices, become exploitable. According to the Securities and Exchange Commission's 2024 examination priorities for private funds, the agency has identified financial statement integrity at portfolio companies as a specific area of heightened scrutiny, signalling that regulatory attention to exactly the kind of manipulation alleged at Mobileum is increasing. For the executives charged in this case, the personal consequences are severe and are still unfolding. For the investors, who lost hundreds of millions of dollars, the financial consequences are real and largely unrecoverable. For the employees of Mobileum, who had nothing to do with the alleged fraud and are now working inside a company defined by it, the consequences are perhaps the most unjust of all. And for the private equity industry as a whole, the Mobileum case is another piece of evidence for a proposition that should be, by now, unambiguous. The due diligence process that the industry has standardized is not adequate to detect a determined and sophisticated management team willing to fabricate the numbers that process relies on. Fixing that is not a regulatory problem. It is a professional practice problem, and it requires the industry to do something that competitive deal dynamics make genuinely difficult. Slow down, go deeper, and verify independently rather than trust the documentation that the people being paid to produce good numbers have provided. The pressure that produces fraud is structural. The verification that prevents it is a choice. Bobby Srinivasan and Robert Maddock have pleaded not guilty. The case will go to trial. Whatever the outcome, the architecture of the alleged scheme, the metrics that were targeted, the mechanisms that were used, the due diligence gaps that were exploited, is already part of the public record. That record is worth reading carefully, because the next Mobileum is already out there. Inside a clean-looking pitch deck with a confident management team presenting ARR figures to an investor who has not yet picked up the phone to call the customers. If this gave you a clearer picture of how fraud operates inside the private equity ecosystem, share it with someone who needs to understand this before it costs them. Subscribe for more investigations into the financial systems and cases shaping the business world. Drop a comment below. What do you think the private equity industry needs to change after cases like this?